I'm very happy to be here and to chair this panel on one of the most important topics, certainly at our times, which is the relation between finance and the real economy. We've been going through some decades of an economy which has been very much dominated by finance, and we had a bad experience some time ago, and since 2008, and now I think each and every year we're going forward, we get new ideas and new insights on what has happened and what could radically change in the relation between the finance sector and the real economy. I think that's something which goes on, and I'm very happy to have some very intelligent and smart people on the podium to discuss this and to see if we can go forward and have some new ideas. And then after some presentation of the panelists, we will have a discussion on the podium, and I will invite you to ask questions as soon as you want. The general questions we have to go through is what could be the new relation between, the new balance between the real and the real economy and the finance system. We can discuss some special topics like what could be done, for example, with introducing financial transaction taxes, and going further on to see what regulation in the financial sector could be helpful to redefine the financial sector. I will just briefly introduce our panelists and ask them to give us their ideas for about 15 minutes, and then we're going to start to discuss. We're going to start with Gerry Epstein from the University of Massachusetts, who's co-director of the Political Economy Research Institute and professor of economics. Thank you for being here. Eckhard Hein, who's professor of economics at the Hochschule für Wirtschaft und Recht in Berlin, HWR in English. Yeah, Berlin School of Economics and Law in English. And then to my left, Damon, who's a lawyer and associate general counsel for the AFL-CIO. I would like to ask you to start your introduction. Thank you.
Good morning. As was just said, I'm Damon Silvers. Although I've been promoted since my bio, I guess, I'm the policy director of the AFL-CIO, which is the central body of the U.S. labor movement. Let me first begin by saying that on behalf of the AFL-CIO, how grateful we are to the Hans-Böckler-Stiftung and the Friedrich Ebert Stiftung for co-sponsoring together with us this event and the prior event that was alluded to earlier in Washington last month. The fact that we were able to put together such a high-level transatlantic dialogue on shared prosperity has had, as I think Tom Pally mentioned earlier, a very significant impact on economic policy discourse in the United States. And I'm very honored to be here and hope that this meeting will be able to achieve similar ends. This panel's subject is the relationship of the financial system to prospects for growth and job creation and shared prosperity in the real economy. In the remarks I'm going to give, I think you need to understand that they are substantially reflections on my role in these issues in the United States over the last 10 years. Starting with a variety of advisory roles that I was involved in with the George Bush administration, oddly enough, and then the experience that I had serving as a part of the congressional oversight process for the U.S. bank bailout, the TARP, and continuing to work that I currently do on behalf of the American labor movement in advising both the Treasury Department and the Securities and Exchange Commission on issues of systemic risk. Now, one of the extraordinary intellectual consequences of the crisis that began in 2007, and which I think it's clear we are still in, is that it forced the economics profession to adjust its discourse on the basic question of whether there is a relationship at all between events occurring in the financial system and macroeconomic outcomes. Now, despite the fact that nearly every policy change that has occurred in relation to finance in modern history in any country has been justified in political terms, in terms of its supposed positive impact on the real economy, at the same time, the prevalent view, at least in the last 30 years or so during the so-called Great Moderation, the prevalent view among academic economists before the crisis was that financial markets had no impact on macro outcomes. And even after more than 40 trillion euros in real economy losses, according to the Bank of England, following the financial crisis worldwide, it has taken no less an authority than the International Monetary Fund an entire symposium in 2010 to resolve that there was indeed a connection between financial markets and the real economy. I found, as a non-economist attending that meeting, I was remarkable that this seemed necessary. Now, perhaps it is not surprising that now that we understand the downside risk of inadequately regulated financial markets, that the focus of policymakers on both sides of the Atlantic has been on addressing the threat of future systemic financial shocks. Far less attention has been devoted in the aftermath of the crisis to the much more important question of how to manage the consequences of the actual major financial bubble that just burst, and how in future to ensure that financial markets and financial institutions play their proper intermediary role in a manner that actually contributes positively to sustainable growth and job creation, rather than merely more safely facilitating unproductive speculation. Now, since the beginning of the crisis in 2007, we have seen this particular issue, or this particular pair of issues, right, managing the consequences of the burst bubble and ensuring that the financial system does its job properly in the future, badly mismanaged on both sides of the Atlantic. In many ways, the nature of the mismanagement seems to be distinct between the European Union and the United States, but I believe when looked at closely, they share some common key features. Now, as we all know, the economic crisis that overtook the world in 2008, in 2008, began as a financial crisis affecting U.S. credit markets, and in particular, U.S. housing credit markets. In the aftermath of the crisis, U.S. policy focused on maintaining the health of what had become a highly concentrated banking sector, rather than on returning over-leveraged households to financial health. And you all, I was very fortunate to have Bob Poland put all the slides for my presentation up earlier this morning. In particular, the slides on household wealth and housing prices. While it is true that the Federal Reserve's quantitative easing policy has reduced the cost of debt in the United States for both households and firms, direct balance sheet assistance in the form of both equity and subsidized debt was rendered by the United States government largely to firms and not to households. So total outlays to banks in terms of equity and subsidized debt was measured in the trillions. Household assistance was approximately $50 billion, most of which was unspent in the TARP. In fact, the conception of how to rescue the financial sector by U.S. policymakers, which was effectively by diluting but not eliminating existing equity in the banks, guaranteed that households would have to make good on obligations that were priced based on inflated bubble-era real estate values. And we had an exchange about that earlier today. Now, this approach has become so embedded in U.S. financial policy since 2007 that it has largely been forgotten what a departure this approach was from how the U.S. had handled its two major prior banking crises since the creation of the Federal Reserve at the beginning of the 20th century. Both of these major crises, the Great Depression and the savings and loan bailout, were managed by the write-down of inflated bank assets and the attendant restructuring of bank balance sheets and relief to borrowers. Now, in Europe, a similar dynamic has occurred in some member states, Ireland and Spain, for example, around household debt. But the more important dynamic has involved the interaction between public debt and the banking sector. It is hard, looking through sort of ideology and rhetoric, it is hard not to conclude that fundamentally European financial policy since the beginning of the crisis, and particularly since 2010, has European policy responses to the collapse of the global financial bubble has had the paramount goal of preserving the stability of the European banking system as an end in itself. In other words, with relatively little concern for what that goal might mean for short to medium-term macroeconomic outcomes. So what might financial policy look like if it was actually oriented toward promoting long-term sustainable growth in the real economy? Such policies, it seems to me, would seek to achieve the following interlinked goals. One, to minimize the impact of the past, the debt overhang left by the bubble. Two, to promote the availability of commercial credit for the real economy. And again, Bob Poland talked about this a bit this morning. Three, to minimize the cost imposed on the real economy going forward by the process of financial intermediation. Financial intermediation is a critical function in a properly working economy, but there's no reason it should cost more than it needs to. Fourth, ensure that there is adequate investment in public goods, and I'm going to talk about that in some detail in a moment. And finally, to manage the risk of future speculative bubbles damaging the credit system. It may be hard to prevent speculative bubbles in general in human society, but they don't have to do the kind of damage that the housing bubble of the 2000s did to the world economy. Now, the first goal, minimizing the impact of the past, requires somewhat different approaches in the United States and Europe. In the US, it requires principal reduction in home mortgage loans and the consequent restructuring of bank balance sheets, with the result of which would result in bringing liquidity back into commercial credit markets. Again, refer to Bob Poland's remarks this morning. In Europe, the issue is really the extent to which the ECB allows bondholders to manage fiscal and monetary policies in the interests of creditors as opposed to in the broader interest of the economy as a whole and the public. Since August, as everyone here certainly knows better than I, the ECB has come to understand that counteracting the bond market vigilantes is necessary at some level, even if your purpose is fundamentally maintaining the European banking system as opposed to maintaining the health of the European economy. But while the ECB and the IMF are no longer allowing public creditors to have direct control over economic policy through the bond markets, they've substituted for that their own command and control mechanisms that appear to be having essentially the same effect. Now, the remaining goals that I outlined require a set of interlocking policy initiatives that are designed to foster sustainable, long-term, low-cost financial intermediation. In other words, returning to the model of the banking system as a kind of public utility, and not as a competitor of venture capital, as an arena of high-risk, high-return investment strategies backed up by implicit public guarantees. The key measures that would achieve this goal are separating commercial credit institutions from financial market-oriented institutions. In other words, the return of what in US terms is called a Glass-Steagall type of banking regulation. A tax regime that ceases to subsidize speculative activity, in other words, a financial transactions tax, and in the United States and much of Europe, the third policy measure that will be necessary from a variety of political economy perspectives is to limit the overall concentration in the financial system. Now, I want to conclude by focusing on two issues that are embedded in these financial policy debates. The first is the question of what exactly we are asking of financial markets and financial institutions. There is no question that financial markets provide a certain type of narrowly defined efficiency. How narrowly defined? It seems to me that the only part of the efficient capital market hypothesis that has survived the empirical tests of the last 2 decades is its weakest form. In other words, that you can't always predict future prices using past price data. I say always because I think you could pretty much determine future prices in the U.S. housing market and U.S. housing-related securities in 2005 by looking at past pricing data. So occasionally you can do it, but mostly you can't. It seems to me we have learned at a great cost that capital markets are not good at evaluating complex interlocking issues of political economy, technology, or science. Poland's housing price slide, as I said earlier, suggests that capital markets may not even be very good at evaluating simple economic problems. But consider this fact. Today, as we meet, after all we have supposedly learned about financial bubbles, it is not possible to reconcile the valuations of energy companies, on the one hand, the valuations of insurance companies and property companies, on the other hand, and climate science. One of the three has got to be wrong. One thing we know with some certainty is that private capital markets will not on their own allocate sufficient capital to public goods to produce sustained economic growth. Properly understood, the financial transactions tax is a policy solution to this problem. If the European Commission's assessment of its revenue potential is correct, and just understand the shift geographically here, if the European Commission's understanding is right, the FTT has the potential to fund as much as half of the US's infrastructure deficit over the next 10 years if we adopted the European proposal for the FTT. But given the challenge of climate change and the global shift from wages to returns on capital, even a global FTT is not going to be enough to fund the world's public good needs. Meeting global public goods needs will require a much more significant globally coordinated approach to the taxation of returns on capital. Effectively, and most importantly, an end to the toleration by the world's major economies of a global tax system effectively dominated by the existence of tax havens. And this challenge brings me to my final point about financial concentration and political economy. A number of commentators have pointed out the pairing in post-war Europe of social democracy and concentrated financial systems. But in the US, we now have considerable experience of the consequences of the combination of highly concentrated universal banking with a weak private sector labor movement. Now, I leave it to you to decide and determine whether the EU as a whole is more like the post-war social democratic model of Northern Europe or more like the United States at the end of the 20th century in terms of this combination of either strong unions and financial concentration or weak unions and financial concentration. But I can tell you that recent US experience suggests that a political economy dominated by concentrated universal financial institutions without a hegemonic labor movement is incapable of generating public policy outcomes in the public interest, and that this particular type of political economy represents a fundamental threat to the public's support for democracy itself. So, to explain what I mean, let me point out some peculiar facts about the US political system currently. Polling that has been done by a wide variety of independent sources over the last 5 years during the economic crisis has shown that the American public, by wide margins, supports a set of obvious public policy initiatives needed for long-term sustained prosperity. Accountability for the banks, legal accountability for what they did to cause the financial crisis. Progressive taxation, infrastructure investment, the rebuilding of US manufacturing capacity, protecting our social insurance system as a primary public policy objective. Each of these ideas gets more than 70% support among the American public. And yet not only are these steps not being taken in Washington, they are largely outside of the mainstream of Washington policy discussions. This disconnection between the public and governing elites over economic policy, and in particular over financial policy, over the treatment of the banks, right, was the primary driver in the rise of what one German politician has described to me as a right-wing cult in the US congressional elections of 2010. And we are all aware of parallel disturbing developments unfolding now in the politics of the EU and its member states along precisely these dimensions. And so I think it is no coincidence, it is no coincidence, and it is a very important fact that in the last US elections in 2012, when a number of Democratic Senate candidates, and people understand that the Senate in the United States is a far more powerful body than the House. Senate candidates are very significant political actors. Senators are very significant political actors in the US political system. A number of Democratic Senate candidates won elections for the first time in the recent history of the US Democratic Party without the support of the financial sector at all, and won by large margins by advocating the precise agenda I just went through that the American public supports, but that has been relatively marginalized in Washington. And that yet the first concrete policy initiatives being supported by the most prominent of these newly elected senators, my former colleague in bank bailout oversight, Harvard professor Elizabeth Warren. Her most prominent initiative over the last 2 months has been a relentless pursuit of the notion that what must be done in the United States is to limit the size of financial institutions. And I think that tells us something about the centrality of that agenda to the entirety of what I just went through in terms of what is necessary in the public policy arena to ensure that the financial system actually serves the real economy. Thank you.
Well, thanks to the organizers, thanks to Gustav and Tom for giving me the opportunity to say a few words in this session, which is dealing with the relationship of the financial sector and the real sector of the economy. And this is a very wide topic, and I've chosen to focus a bit on the aspect of income distribution, because that's a very important aspect, in particular if you're going for an agenda of shared prosperity, I guess. So if we just take a look at what has happened over the last 3 decades or so, and which has led us into the crises we are, from which we are still suffering right now, the latest episode being the Euro crisis, of course. I think this episode is characterized by major 4 features, which I call 4 important features of finance-dominated capitalism. Others call it financialization. It's a matter of taste, how you would like to call it. I think from a macro perspective, we have 4 important features of this. And I think an agenda for shared prosperity will have to deal with these features and has to provide alternatives. The first one is, I think, the massive redistribution at different levels, which we've seen, and I will address this in particular here today in the 10 or 12 minutes which are left for me. The second one is this effect on investment in capital stock, which we've seen by the dominance of shareholders through a variety of channels, which have caused the capital stock growth in major countries to come down to rather minor growth rates. Together with redistribution, this should have had a depressing effect on aggregate demand and also on growth. But this period of finance-dominated capitalism has provided 2 outlets or 2 alternatives to this. The one is the generating the potential both from the supply and from the demand side in credit and financial markets for what we call a wealth-based and debt-financed consumption boom. This is obviously the model being followed in the US and other countries and other European countries. The problem is, of course, that you run into risk of over-indebtedness of private households, and that's, again, the problem we're still facing, or the outfalls of these problems we're still tackling. The other alternative is to go for what I like to call mercantilist export-led strategies. That's basically the German model. And the risk is, again, obvious. The risk is imbalances at the global scale, but also at regional scales. One, I would say, of the major reasons for the Euro crisis we are facing. Now, let me talk a bit more about the first channel, which I think, or the first feature, which I think is the most basic and the most important one. Because it feeds into all the other channels, together, of course, with other characteristics of finance-dominated capitalism. I think these figures and data are quite well known. We have a tendency towards redistribution at the expense of labor, which is true for, well, the set of developed capitalist economies which you see here. Germany and the US are highlighted. You see cyclical averages, and you see that both on both sides of the Atlantic, so to speak, we have seen this redistribution at the expense of labor. It's true for the household distribution of income. You see here as one indicator the Gini for market incomes. You see it's risen both in Germany and the US, as it did in many other countries. And it's also true for the Gini for disposable incomes, at least if we take a look at Germany and the US. A third redistribution which we've seen, or a third indicator of the redistribution we've seen in the age of finance-dominated capitalism is the rise in top incomes. And this is data from the World Top Income Basis, which are frequently used nowadays, and this is something you might have seen as well. It's the data for the US and the UK, which you see here with a dramatic increase in top incomes, starting roughly in the early 1980s and now reaching levels not seen since the late 20s, early 30s. If we take a look at Germany, the redistribution or the tendencies are not as clear-cut. In Germany is here the upper line or the upper triangles, one with and one without capital gains. You see that in Germany we haven't seen this increase yet, but the income share of the top 0.1% are in international comparison at a very high level. So here the comparison is the Netherlands, but if you extend the countries in consideration, you will see that it also holds true for the comparison with other countries. Now these are the observations, and I could add furthermore on these observations. The question now is, how is this related to this finance-dominated capitalism? A last feature which I forgot to mention. If we take a look at the composition of these top incomes, again the data are from the World Top Incomes database, you see that in particular for the US, here we have a feature which Piketty and Say's, one of the major contributors to this kind of research, have called the working rich. So an increase in the share of wages, salaries and pensions in the top 0.1 income. In the US it also holds true for the top 1% incomes, basically related to top management salaries. For Germany, this tendency is not as pronounced, but we also find it here. It's not for the top 0.1, but for the top 1% income. We also see, this is only data till 2003, we also see a slight increase in the share of salaries here in the top 1% income share in gross market income. By the way, this is market income, so it's income before government redistribution in terms of taxes and social transfers. Now, how can we explain this and relate this to finance-dominated capitalism? And I was told I should not introduce too much of a theory, but in order to think about distribution is a very difficult topic, I think. We don't have the theory of income distribution on which we all can agree on. So this is a particular view, a view which is based on the work of Michael Koletsky, which I like very much because he gives us a very clear view on the determinants of income distribution. And what you see here in the upper line are the 5 major determinants of the gross profit share according to Koletsky. It's price competition in the goods markets, which has an impact on the markup over prices, over unit labor cost and unit variable costs. It's the bargaining power and activity of trade unions. It's overhead cost and the gross profit targets. Then prices of imported raw materials and semi-finished products. So basically the profit claim of the external sector of your economy. If you have a developed capitalist economy, which mainly imports raw materials and semi-finished products. And then we have a statistical effect, which I think is quite important when we come to financialization, which is the sectoral composition of the domestic economy. Now, if we then go through the features of this finance-dominated capitalism, we can single out or identify some major channels through which the dominance of finance has had an impact on these distributional trends we've seen, and that's only so far related to functional income distribution, so to the profit share. And I've tried to highlight this here. I think there are mainly the 3 main channels is through the effect on the bargaining power of trade unions, through overhead cost and gross profit targets, and through the composition of our economies. Basically, increasing shareholder value, orientation and short-termism of management has had an effect on the bargaining power of trade unions, has weakened bargaining power of trade unions, it has increased gross profit targets, and therefore has had an impact on the profit share. Rising dividend payments can be considered as kind of overheads, and they therefore have also had a positive impact on the profit share. The same is true for interest payments. This holds in particular for the 80s when interest rates have risen. Then we have the increase in top management salaries, which here have an impact on the profit share. But if we go to the national accounts, we won't find it there, because in the national accounts, management salaries are part of compensation of employees. So the downward trend of the labor income shares, which we've seen, include the increase in top management salaries. So if we reduce or deduct this from this trend, the trend would have been even more dramatic. Then we have the increasing relevance of the financial to the non-financial sector. It affects the bargaining power of trade union to the extent that labor organization and labor power in the financial sector is weaker. And it has a sectoral composition effect if the profit share in the financial sector is higher than in the non-financial sector. This is something which we've seen in particular in the US, not in Germany. Liberalization and globalization of trade, of finance and trade, affects bargaining power of trade unions through the threat effect. Then the deregulation of the labor market, of course, has a negative impact on bargaining power, and downsizing of government affects bargaining power, and it affects the composition of the economy, or the profit share through the composition of the economy, because the government sector is a non-profit sector. So, but basically, I think if we take a look at distribution, we have the effects through bargaining power, through overhead costs and profit targets, and through the sectoral composition of the economy. Now, what does this imply for politics? I think an agenda for shared prosperity, or what some other people call a wage or income-led recovery strategy, would have to address the main causes for this redistribution, which we've seen in the age of finance-dominated capitalism. So it would have to address bargaining power of trade unions. Bargaining power of trade unions would have to be improved. It would have to address the issue of overhead costs, including top management salaries and profit claims of financial wealth holders. It would have to be reduced. It would have to address the sectoral composition of the issue of the sectoral composition of the economy if we want to have a stabilization of the labor income shares, or even a redistribution in favor of labor and low incomes. Of course, wage or income-led recoveries or agendas for shared prosperity should also address the issue of personal distribution, in particular the issue of the distribution of disposable income. And therefore, we would have to address the issue of wage dispersion. So wage dispersion would have to be contained, and the inequality in the distribution of disposable income would have to be reduced. There are different instruments for this. Legal minimum wages in terms of the containment of wage dispersion, progressive taxation and social policies for the disposable incomes. Now I'm coming back to my first slide. How is this related to a broader policy agenda? A broader policy agenda which one might want to call agenda for shared prosperity, or I think we have also called it in some papers a Keynesian New Deal at the global and the European level. How is this related? And that will be my last slide. And now I'm linking this to the issue of regulation of the financial sector, because I think that any policy agenda which should bring us out of the problems which we are facing right now can neither rely on another debt finance consumption boom. I don't see it yet, but it could be an option, of course. Nor can it rely on export-led mercantilist strategies, because the world is a closed economy. So this means that the alternative has to be a kind of income-led or wage-led strategy, and it has to be embedded in the Keynesian New Deal or an agenda for shared prosperity. And I think this strategy should have three pillars, or that's how I like to think about it. Maybe there are more pillars for it. But I think basically three pillars are important. The first one is the re-regulation of the financial sector, which of course in itself has a purpose. addressing the problems we've seen in the financial sector over in particular in the course of the crisis. It would have to address, of course, the issues of transparency and uncertainty, the issues of providing incentives for long-run growth instead of short-run profitability, and would have to address the issue of systemic instability or reducing systemic instability. But as a kind of byproduct, it also would have to address the issue of distribution. If we downsize the financial sector and the profit share in the financial sector and high incomes in the share of high incomes in the financial sector are higher than the rest of the economy, this will by itself have a progressive redistribution effect. The reduction in top management salaries and profit claims of financial wealth holders will have a favorable effect on distribution and therefore stimulating the economy, as will the improved bargaining power of trade unions. The second pillar, and that's the link to the previous session, so I don't want to get deeper into it because we've already discussed some of the issues here, but I think they also related to distribution. I think the distribution issue is also in this second pillar, which is the reorientation of macroeconomic policies. So that's a policy of low interest rates on part of the central bank, fiscal policies stabilizing the economy in the short and the long run by means of running deficits if necessary, beyond the trade cycle, and progressive taxation and social policies, and also wage policies going for some wage norm productivity growth plus the inflation target. And the third pillar of this policy package is the reconstruction of international macroeconomic policy coordination. Again, this was briefly touched in the first panel and maybe touched in other panels as well. From the perspective of distribution, this means that we would have to limit the pressure on labor. The pressure on labor to accept wage cuts as a precondition or as an instrument in following these export-led mercantilist strategies, and we would have to go for symmetric adjustment of current account imbalances. Okay, thank you. I think I've run out of my time. The rest is for the discussion. Thanks a lot.
Thank you very much.
Thank you very much to the organizers for inviting me. I'm very pleased to be here, and I'm especially interested in learning more about the German economy, German economists. We heard about this morning, and Europe more generally. So this panel is about the relationship between the financial sector and the real sector. And if we think about what's happened in the last 3 or 4 years, I think we have a pretty simple and stark answer to this question. According to Andrew Haldane of the Bank of England, the cost of the current crisis is somewhere between $60 and $200 trillion globally. So if you want to look at what impact the financial sector has had on the real economy over the last 5 years, this is pretty much it. And in fact, this has been building up for several decades, and as Bob Poland mentioned earlier today, and others on the panel mentioned just now, the roots of this relationship, this destructive relationship between finance and the real economy, has lain in the financial deregulation that has occurred over the last 20 years or so. And indeed, financialized capitalism has been locked in a truly devastating dynamic of deregulation, financial deregulation, financial innovation, an explosion of the financial sector, and then a bailout of the financial sector by the central banks, by the governments. And this has led to a devastating cycle, which in fact has contributed to an enormous growth in the financial sector. Why has the financial sector grown to be so large? It's because of this dynamic of deregulation and bailout. There are many data slides that we could show to demonstrate this, but if you just look, for example, at the United States, total financial assets as a percentage of GDP grew from about 400% in the early post-war period to over 1,000% just before the crisis in 2007. If one showed data here in the European economies, this would be even greater, I think. Financial sector profits as a share of total profits in the US went from about 20% in the Great Depression, doubled to around 40% just before the crisis. So if you take total profits of the entire economy, the financial sector took down 40% of those profits just prior to the crisis. In the UK, we have something quite similar. In 2000, financial sector profits were 10%. By 2007 or 8, tripled to 30% of the economy. There's one additional cost to the enormous growth of the financial sector, and that's what Eckhard has been talked about in his presentation. This massive growth in the financial sector has contributed to inequality. Eckhard presented much more evidence than this, but let me just show you a few graphs. This comes from some work that my colleague Arjun Jayadev and I have done. The bottom line shows the growth of labor income in the United States from 1952 to 2013. And the higher light blue line shows the growth of what we call the rentier income, which is income, interest, dividends, financial profits. And as this graph makes quite clear, the growth of rentier income has been dramatically more rapid than labor income in the United States. If you look at the top 1% of income earners in the United States, what this graph shows, we have the rentier share on the horizontal axis. We have the share of the income of the top 1% on the vertical axis. The data go from 1952 to 2007. What we see is that after 1980 or so, when a lot changed in the world, with Margaret Thatcher coming to power in England, Paul Volcker taking over the chairmanship of the Federal Reserve in the United States, etc., we see that there's a positive relationship here between the rentier share and the top 1% of income earners in the United States. So a direct correlation, doesn't mean causation, between the rentier share and the top incomes. Now, regulators in the US and in Europe and elsewhere are trying to regulate the financial sector in the aftermath of the crisis, ostensibly to reduce the likelihood of a future financial crash and the necessity for another massive taxpayer bailout. And bankers and politicians on both sides of the Atlantic, if they're not cooperating, that's where the real transatlantic cooperation seems to be happening. It's among the bankers on both sides of the Atlantic, unfortunately. They make lots of arguments as to why they should not be regulated. They say the rules will harm banks and reduce their competitiveness. Banks will move abroad. Intermediation will become more expensive. There'll be banker brain drain. Now that means that the top minds who engineered the financial crisis will move from New York to London if we try to regulate them more in New York than we do in London, or they'll move from Frankfurt to London if you try to regulate them here in Germany.
That'll raise the average.
In both places. It'll stifle financial innovation. And Jamie Dimon of JP Morgan says, we don't need this regulation. We can manage our own risk just fine. This is before the London well fiasco that we have heard so much about. But here's the point of my talk. If the financial sector is bloated, if it is too big, way too big, if it is inefficient, then most of these arguments lose force. That is, we want to shrink the financial sector. We want to reorient the financial sector. It's fine if some of the banker brains drain to someplace else. Goodbye, good riddance. And so what we want to look at is what the financial sector actually has contributed to the real sector, and assess how to structure it so it can contribute more or be less destructive. So how socially productive are these massive financial sectors we have in our economies? Can and should they be cut down to size, and by how much? And what should be kept and how should they be reoriented? These are the kinds of questions that I want to address. I can't fully address them in 12 minutes, but I'll give an overview of some ideas. Has this growth in the financial sector contributed positively to the overall economy? Well, a simple picture gives a first hint. This comes from the work of Thomas Philippon, who's done some interesting work in this area. And it shows the relationship between, on the vertical axis, the 10-year change in the finance share, that is, the share of national income going to finance in the United States. And on the horizontal axis, the 10-year growth of GDP per capita. And what this scatter suggests is there's no clear relationship between the share of income going to finance and the GDP growth per capita in the United States. Now, there's been a lot of research recently on looking at this issue more generally in Europe, the United States, and other countries. The relationship between the size of the financial sector and the rate of growth of GDP per capita. And what this recent research has shown is that there seems to be a U-shaped relationship, an inverted U-shaped relationship. That is, up to a point, an increase in the size of the financial sector does seem to contribute to economic growth, but past that point, it seems to actually reduce economic growth. Many of our economies, the size of the financial sector is past the turning point. That is, the financial sector is too large. And this research is, you can find it on Vox.eu, you can find it in various other websites. This is useful research, but it doesn't really tell us what types of financial activities contribute to socially useful outcomes, like job creation, as Damon was talking about, risk reduction, retirement protection, and the financing of socially useful investment. We'd like to know more precisely what it is that finance has been doing towards these ends and what it could be doing better. So let's just briefly look at the roles of the financial sector as we think of them and as we find them in textbooks. So we talked this morning about textbooks. One role is to channel finance to productive investment. Damon also talked about this in his presentation. Provide mechanisms for households to transfer income over time, that is, saving for retirement in a secure way. Help households and businesses reduce risk, so-called risk sharing. Help provide stable and elastic liquidity to the economy. Engage in useful financial innovation that will make all this better and cheaper and more socially productive. There are also private roles for finance. Make profit for shareholders and make incomes and bonuses for rainmakers and the management. Now, I think what's pretty clear, but this is the claim I make, and I think others up at the table make as well. Finance recently has done a much better job of furthering the private roles than furthering the social functions that finance should play in our economy. And this is putting it rather mildly and politely. So what are the estimates of the contribution of the financial sector to the real economy? Has finance recently been channeling finance to productive investment? Bob Poland spoke this morning about the problems in financing small businesses in the U.S. economy. Indeed, we can think of the banks and financial sectors that we have after the crisis as being like zombie banks. Bob showed how they are accumulating trillions of dollars of liquidity. They're not channeling credit to the real economy. But the point I want to make is that this problem of these financial sector has long predated the crisis. Long before the crisis, finance in the United States, in the United Kingdom, and I would suspect here in Europe, stopped channeling resources sufficiently to the real economy and started engaging in massive speculation and trading and other kinds of activities that did little to improve efficiency or productivity in the real economy. So, for example, a high share of lending in the US and the UK has been going to household and property development and to support trading in financial assets. This is true in other countries as well. Now, to take a look at this, some colleagues and I looked at what we call the finance gap, which is essentially the amount of external finance that different sectors of the economy need to accumulate capital, to make investments. So it's the amount of external financing that they need after they use their internal reserves, retained earnings and so forth, to finance investment. And we looked at it in several different countries. I'm just going to present the US and UK data here. This is for non-financial corporations in the United States from 1950 to 2009. The top row shows the average financing gap relative to capital expenditures of non-financial corporations in the US. And essentially what this shows is that in the earlier period, post-war period, the non-financial corporations got external financing anywhere to finance 11% to 20% of their capital expenditures. But starting around the 1990s, they were only borrowing about 5%. They were only financing about 5% of their capital expenditures from external financial markets. And in the period 2000 to 2009, they were actually lending to the capital markets. That is, these non-financial corporations themselves had become financialized. They started making income from lending to the financial sector rather than borrowing from the financial sector to invest in capital. This is on average. We have a similar story with the UK non-financial corporations, less and less going to the external markets to finance investment, and indeed by the lower figure, which is a different estimate, they're actually mostly lending to the financial sector. Now, how much income has the financial sector taken out of the system or extracted from the economy in relation to this declining contribution that they've made to financing real investment? Well, what we find, and this is for the United States, that the income of the financial sector relative to the finance gap, how much they provided to the economy, has doubled between 1946 from 0.4% to 2010. In other words, finance is getting paid $2 in 2010 for every dollar that they give to financing the real sector, compared to $1 which they received in 1946. They're extracting more income for each service they provide. Or the cost of intermediation has doubled, is another way to look at this. Looking at these data then suggests that the financial sector in the United States might be as much as twice as big as it needs to be. If you look at what it was doing in the 1950s and 60s relative to what it's doing now and the income it's getting for it, if we just look at the finance gap. Now, the financial sector, so what has it been doing? How has it been generating so much income? Well, for one thing, it's been lending to itself. The financial sector has been lending to itself, one financial institution to another financial institution, to engage in trading and proprietary activities. So this is a graph of net lending of the financial sector to itself in the United Kingdom from 1963 to 2012. And what it shows is that in the early 60s, it lent about 5% of its credit to itself, and before the crisis, it was up to 40%. In the United States, it jumped again from around 5% in the 1960s, all the way up to anywhere between 40 to 60% right before the crisis, lending to itself rather than to the real economy. Now, what about trading? Part of the reason it was lending to itself was so that it could engage in all kinds of speculation and trading. This graph is from my colleague Bob Poland, who generously lent it to me, which shows the U.S. stock market trading relative to corporate investment. So a lot of this trading, and this is just stocks, we could look at other kinds of assets as well, has gone up tremendously relative to real investment in the U.S. economy. This goes from 1970 to 2005. In 1970 to 79, trading was 1.3 times corporate investment. By 2007, it was 26.8 times corporate real investment. So we went through this whole list of these roles of the financial sectors. So far we've talked about channeling finance to productive investment, not so much. What about mechanisms for households to transfer income over time, households and businesses to reduce risk, help provide stable and elastic liquidity, and financial innovation? I think to once again look at Haldane's estimates. What we've seen in terms of allowing households to transfer savings over time, Bob Poland showed this morning the huge wealth loss of households in the U.S. as a result of the crisis. So instead of transferring income to the future for retirement, many households in the United States have now lost their retirement income. It's the reverse transfer. In terms of risk sharing, what we've had in the U.S. and also here in Europe, I would suggest, is the privatization of benefits, that is, the banks have continued to make enormous profits, and the socialization of risk, that is, risks have been put on households and workers to bail out the banks and to pay for this with unemployment and the loss of their pensions. What about providing stable and elastic liquidity? Has the financial sector served that function? Well, it turns out this liquidity provision idea is what I call the last refuge of scoundrels. If you look at the debate over the Dodd-Frank bill in the U.S. That Bob talked about earlier this morning, Damon's been involved in this. Any kind of financial regulation in Dodd-Frank that you propose, the financial sector comes back and says, oh, we can't do that because that will reduce liquidity. If we reduce liquidity, that will make financial activities more costly. So the end users will have to pay higher costs because we're going to reduce liquidity. The fact of the matter is, much of the liquidity that was created by the financial sector through financial innovation is what generated these financial asset bubbles and liquidity cycles. So reducing liquidity actually can be socially useful if it's done in the right way. We'll come back to that. Financial innovation. Again, what they say is if you impose these financial regulations, you're going to reduce financial innovations. Paul Volcker said he thinks the only useful financial innovation in the last 25 years has been the ATM machine. And in fact, the evidence suggests that Paul Volcker could well be right. Most surveys of financial innovation cannot find any positive impact of financial innovation on economic growth. There's a lot of more research to be done in this area. I'm just citing the most recent comprehensive survey by two mainstream economists in the United States published in the Journal of Economic Literature. How much time do I have? 2 minutes? Okay. I have 2 minutes. What we found in some studies that we did looking at some of this literature is that a large share of financial innovations, up to 40%, but I think probably more, is used just to avoid regulations and to avoid taxes. This is not increasing the size of the economic pie. This is to shift part of the economic pie from society to finance, rather than to be efficiency enhancing. So how can we restructure finance to better serve society? And I have 1 minute to tell you. The current policy is to increase capital requirements. The problem with this is that they're easily evaded and they're pro-cyclical. They can help, but they're not sufficient. A second policy in Europe and in Basel and so forth is to increase leverage requirements, which if this were done seriously and at a high level, could help tremendously. This could help reduce the size of the banks. But the kinds of leverage requirements that are being proposed are very modest and not up to the task. Financial transactions tax can also be helpful in reducing speculation and enhancing socially productive investment. And the question is how high that tax has to be to really serve that purpose. There's also been movement on reducing bonuses, but unless you reduce the incentive to take risky investments, even reducing bonuses is not going to do the job. You have to reduce the incentive for taking excessively risky and speculative investments. One thing that we've proposed is a financial product safety commission, sort of like the Food and Drug Administration in the United States, to assess financial innovations before they're spread throughout the economy to ensure that they're safe and productive. Some economists at the University of Chicago, believe it or not, have also proposed something similar. Limit destructive risk-taking by large financial firms, splitting up the proprietary trading from other kinds of financial activities, as Damon suggested. Phase out crisis-driven government guarantees and limit bailouts. Reform the rating agencies, which through their perfidious ratings help contribute to the crisis. And I think a very important component of this, which is not sufficiently talked about, is to build up the non-private financial sector, more cooperative kinds of financial institutions, more government financial institutions, and what I call finance without financiers. We need finance for our economies to function. What we don't need are excessively wealthy, speculatively oriented, and politically connected financiers. And I think on that point, I'll end. Thank you very much.
Thank you very much, Gerry. Excellent. I'm personally reassured because I've been writing a book on the financial system and on this question, and this will come out tomorrow. So you didn't say anything which could have shown me that it's completely wrong what I've been written, because this would have been difficult to convince my publisher to change this until tomorrow. So we're in the same direction, I think. And but what I would like to know, we have now a lot of, I mean, the diagnosis in general seems quite the same. I mean, there's a fundamental problem with the financial sector and the fundamental problem with the financialization of the sector. I mean, we have to convince many people who don't think in this direction or who aren't as radical as you are. But at the same time, there are a lot of propositions around, and you talked. I mean, we had them all. We had the financial transaction tax. We talked about the capital requirements, bonuses, and all these things. And I got the impression now that it's a lot of things, and it makes it perhaps a lot more difficult to really come to one point or to make it, to sell it to the public, because now we have some financial transaction tax in Europe, we have some restrictions on bonuses, and we have some things about capital requirements in Basel III, but it seems dispersed, and it seems like calming people and telling people, well, we're doing something. Is there something which you would say is the most single important thing to do, which is the main thing to get to the point? Yeah.
I think that's a very important question, and I think it may have been hard to hear this, particularly given that you know, some language barriers here. But perhaps the key point of my presentation is that these issues are intertwined. Right? That, for example, you know, Gerry said we should not have guarantees we should not have public guarantees for the financial sector. It is very difficult, and I've
been there in the room when these decisions are being made, and I can tell you it is very difficult, even for people who agree with that proposition, not to execute the guarantee in the crisis, given the size of universal banks in the current global financial system. And this is quite different from the circumstances that existed, for example, in the United States in the 1980s, when, for example, the stock brokerage Drexel Burnham failed. And the CEO of Drexel Burnham called the Treasury Secretary at the time, Nicholas Brady, who was a Republican, and asked him to bail out Drexel Burnham, and said that Drexel was critical to the U.S. financial system. And Brady, who was not known for being a very sophisticated person, turned to his chief advisor and said, "Drexel is a stock brokerage, isn't it?" And the advisor said, "Yes." He said, "We don't bail out stock brokerages." Hung up the phone. Now, it's a very different conversation when that call comes in from Citigroup, which I believe is now the owner of the residual assets of Drexel Burnham. It's a very different conversation, as are many of the conversations about the specific policy remedies that you've heard all three of us talk about. And so it's critical to isolate how you disentangle this paralyzing political economy. And it is completely intertwined with the subject matter of the last panel. Because there is no way to have a serious conversation about growth and shared prosperity until it's possible to liberate the macroeconomic policy dialogue from the political control of financial elites. It's simply impossible. And I would suggest to you that there are two moves that have to be made, and they are in fact the same move. The first move is to understand that effectively there has to be debt relief in the aftermath of the bubble for borrowers. And that we need to essentially discard the mistaken morality of the Hamburg Declaration in order to do that. And that this is both a moral issue and a very practical issue. The morality is wrong and the practicalities are wrong embodied in the Hamburg Declaration. So A, there must be debt relief. And if there is debt relief, there will have to be restructuring of major banks. And the restructuring of the major banks has to be done in such a way as to reduce their size and political power. And we had a conversation at coffee, some of us, about different national narratives around this subject. I think it's critical for this audience to understand that these were the fundamental steps that led the United States to emerge from the Great Depression as a healthier economy and society than any of the other advanced economies of the time. And that it was the failure, and that the fundamental narrative in Germany is misunderstood. It was not, this has nothing to do with, these outcomes have relatively little to do with early Weimar inflation and everything to do with the contrast between the approach taken to these questions by the Roosevelt administration in the United States in contrast to the approach taken by the Brüning administration in Germany. That is the real narrative. And we are replaying these things at a muted volume right now. And if we're lucky, the volume will stay muted. And if we are not lucky, then we face similar consequences.
Yeah, I mean, you're raising a very difficult question. Of course, the problem is that the financial sector, and Gerry has shown this, has grown and has differentiated to an extent that we might need several regulations in order to cope with all these problems. And if I had time, I would have gone through some of them. Basically, I think the overlap with Gerry would have been large. So, but we should think about it from the perspective of the aims, of the targets. So I think there are three of them. So to increase transparency and reduce asymmetric information and uncertainty. And this has all sorts of elements. Generate incentives for long-run growth of the economy instead of short-run profitability, and then contain systemic instability. I think these are the three main areas, and of course we have seen some progress in some of these areas, but definitely it's not sufficient, it's not enough. If you ask me from a more policy agenda approach, so going for the three most important ones, I would say go for strong public and cooperative banks. that in particular for Germany, protect and defend our three-pillar system against all the attacks we've seen and we might see in the future against the public banks and the mutual banks and their specific regulation. As soon as we have systemic financial institutions with systemic importance, they have to be either tightly regulated or socialized. And the third, I would say, what's very important is cut the link between the banking sector and the shadow banking sector. And therefore, if we want to have casinos, it's fine, but the link between the casinos and the banking sector with access to the central bank should just be cut. I think these are the three most important issues if you go for a policy agenda and if you have to sell it to the public within 2 minutes.
Gerry, just one question, which is completely opposite in terms of realistic things, but why not go back, if I look at all these graphs, why not simply go back to the system of the 60s?
Well, I think you do have to go back to a system where finance serves the real economy rather than the other way around. And where finance does not control politics. So in that regard, going back to the 60s would not be such a bad idea. But you can't go back in precisely the same way. Look, if you want to keep a complex and a diversified financial sector, then you have to have a complex set of regulations. I think the key thing, and this just doesn't disagree with what the other two speakers said, you have to break the structural blackmail of finance. Finance has a stranglehold on our politics now, not just because, like in the United States, they give a lot of money to politicians, but here in Europe, if you really try to have, I was talking with somebody at the break today about this, if you really try to regulate banks here in Europe, the politicians are worried they're going to go bankrupt. And that's going to lead to enormous budget deficits for most of the countries and lead to a financial crisis. So what you have to do is have alternatives to the private banking system that can serve the functions that I laid out in my slides. You have to have cooperative and public finance that can really play those key roles, and then you can wean the economies off of the private financial system, and then you can tax the financial system as much as you want or as little as you want, so that those kinds of activities are really sort of sideshows. Because in fact, most of the activity of the financial sector is a sideshow to what we really need in the real economy. So build up the social alternative to that and tax the sideshow as much as you can get away with.
Thank you. There's one first question. I think you should go to the micros.
Just two short comments on Gerry's presentation. You had quite a long list of characteristics for the banking sector, which also included channeling workers' savings for their future retirement spending. Would you not agree that in order to reduce the size of the banking sector, the banks should just fulfill three fundamental functions, like taking deposits, making loans to the real economy, and then ensuring the system of transfers of payments, rather than acting as capital collection institutions where ultimately the financial sector gets responsibility for whatever is happening with the money that's collected. That's my first point or comment or question. And the second is that you were saying in the future finance should no longer be able to control politics, and you showed these graphs from Thomas Philippon which I think were really striking. A very clever guy. When he has worked as an academic, the trouble is, and that is pouring a bit of water into your wine, is since he's joined politics as an advisor of the French Minister of Finance, he has drafted the French banking law, which is totally void of any substance, which might, make us think that people may be very, good in theoretical terms, but when it comes to government practice, it may turn out to be the opposite of what they were originally thinking.
Yeah, just.
Hello, Fabian Lindner from the Makroökonomie Policy Institute, and I just want to ask you whether the most important point is, really size. I mean, you just have to shrink it, and isn't the kind of framework they have too much monopoly power? I mean, monopoly is something that is very important in economics, and everybody is basically, as an economist, agreeing that you have to reduce monopoly power. And I think exactly what Gerry Epstein has shown is they have charged much too high costs, right, as far as finance is concerned, and this they can only do because of monopoly. And so would that be the most important thing? Because all the other kinds of problems, you just, you tackle with the same kind, you shrink the banks themselves, and then you get rid of the high costs that you have shown, you get rid of the political power, of course, because monopoly is also always a kind of way to extract political power and so on. And perhaps more as a kind of a question is, why did customers of banks accept this bloated prices, right, for, I don't know, IPOs or whatever they did? I mean, there were also customers on the other hand. We all blame the banks, but what about the customers, the corporate customers, who just also accepted those prices? And I'm wondering, because in Silicon Valley, I think, the computer industry is just financing everything out of equity because they don't want to have to do something. I think about Apple. I think about Apple because they are not. They don't want to have the banks in the boat, right? So would that also perhaps be a kind of strategy to go to business and tell them that perhaps they can finance more out of equity or something like that? Thank you.
Thank you. Would you? Yeah, we can take one more, please. Yeah.
I have two questions to Gerry. One fact strike me most, among others, what you said. First, that banking profits or bank profits is 40% of total profits. How is total profits calculated? Does it include capital gains? The similar question, it does not. Then I think the figures, at least in Europe, are quite different. I don't know precisely, but would be very interesting to have shed more light in that. And secondly, you mentioned in one of your last slides the 2 words or 3 words, no bailouts. Can you elaborate a little bit more on that? Because I think the culture of debates in progressive circles in the US and Europe is different. So in Germany and Europe we talk about systemic risks. And no bailouts would be extremely risky, at least this is the common understanding by many people, me too. And in the US also Stiglitz and many others follow your idea, or the Occupy Wall Street movement, no bailouts. So can you elaborate a little bit more on that?
I'll briefly try to answer some of the questions, but then I want to leave time for others to speak. Let me take the last one first. As we know from Hyman Minsky and Kindleberger and going way back, the lender of last resort function in a capitalist economy is very important. So, and as Damon was saying, I think it's virtually impossible to have a strict no bailout rule. That you have to keep the payment system going, you have to keep the financial system operating at a basic level. What I really mean when I say that is you may need to bail out the banking system, but you do not need to bail out the bankers. What happened in the United States, what happened here in Europe, is that the number of the large banks were bailed out. The governments did very little to take over the control of the banks. They didn't fire the management. They didn't do what the Federal Deposit Insurance Corporation does with small banks in the United States. They come in, they take it over, they fire the management, maybe they get somebody else to take it over. They restructure the bank. They didn't do that here or in the United States. So I say no bailouts for the bankers. If necessary, it will be necessary sometime to have lender of last resort activities for some kinds of financial activities to keep the payment system going. I don't really know about Thomas Philippon, so I can't really speak to his integrity. I just know he did some interesting papers. But in terms of the functions of the financial sector, you have to have some ability for saving for retirement. In the United States, part of the problem that we have is this is very privatized. I prefer to go back to a much better public system of saving for retirement, in which case we could keep the private financial sector out of it. That would be a better system. But if the private financial system has to be involved, then there are many reforms we have to do for an appropriate private financial retirement system in the United States. Finally, monopoly power is a huge problem. I mean, if you look at derivatives trading, it's just a few banks that control it, for example. But just having a lot of smaller banks that aren't appropriately regulated can also lead to instability and can also lead to crisis. So breaking up the banks by itself is not a solution. I think it's a big step, but you still need to have proper regulation.
I'm not going to take these in the order that was asked, but I think it's one of the most frustrating aspects of financial policy debate in the United States is reflected by the questioner who said, well, there's a real difference between these conversations in Europe and the US, that in Europe there's an acceptance that you need to intervene in the case of a systemic financial crisis, and that in the United States there's this debate where a lot of people on the left say that there should be no bailouts, left and right, by the way, in the United States. The conclusion, the fundamental conclusion of the Congressional Oversight Panel for TARP, which I served as the vice chair on, in report after report, was that the bailout of the U.S. banking system and the U.S. auto industry was essential. That there was a real risk of large-scale global financial disintermediation in the fall of 2008, and that if no action had been taken, that there was a serious risk of Great Depression level shrinkage in global output. And so we very strongly came down in favor of the notion of bailout in that sense. It's the question of how it's managed. How is the bailout managed? And with respect to the treatment of both equity and debt and within the banks, and with respect to the treatment of the borrowers. Right? And the fundamental problem here was not that we rescued the financial system, but that we rescued it in such a way as to ensure that in the United States, and I believe this is largely true in Europe, although now there's some debate about it, I believe being led by the Dutch finance minister. In the United States, the fixed obligations of every major financial institution were met 100%. Now there were defaults in securitized mortgage bonds, but the credit of major U.S. banks was totally unimpaired, despite the fact that at least in November of 2008, they were all broke, all of them. Right. And I have to really point out here, with respect to Jamie Dimon, that was mentioned a moment or two ago, Jamie Dimon goes around the world asserting that he didn't need a bailout and he shouldn't have to be regulated. It's the most outrageous lie being told by a financial leader in the world today. And how do I know this? Because I sat with Hank Paulson, right, on January 16th, 2009 in his office, when he was literally about to sign the document that rescued Bank of America. And I said to him, why don't you wipe out the equity of Bank of America? You will redeem the honor of the United States government if you do so. And he said, if I wipe out the equity of Bank of America, all of the equity of all of the other major banks will vaporize. That's why I won't do it. Now, I believe he was wrong, But I believe he believed what he was saying. Right? And I believe one of the reasons he believed why he was saying what he was saying was because Jamie Dimon was calling him and telling him that. Right? And these are the realities of the politics of bank bailouts. Now, and so the tragedy of this is that this analysis that rescuing the financial system in a crisis of disintermediation is an essential public policy act, but that the way you need to do it is different from how it was done in the US, and I think to a large extent in Europe, is a lesson that has been lost in a debate dominated by the simplicities, essentially, of the Tea Party, that we should never bail out a bank. Now, a point was made about Apple and equity in the financial system. I think it's important to understand about the US system of financing high-tech ventures. Startup technology companies are never financed with bank loans because they don't have any cash flows. They can't pay the loan. Right? That's why a system of venture capital, equity investing, is so important. Apple is not a startup. Apple doesn't borrow from the banking system, not because they're afraid the banking system will collapse, but because Apple is sitting on a mountain of cash so vast they can't find investments to make with it. Right? And this is not so unusual. Most of the capital needs of large US public corporations have been met internally since World War II. The banking system is important to middle market companies, right? and to small business. That's where the real importance of the banking system comes in, and the way in which we rescued the banking system essentially led it to stop functioning in its most important function. Finally, I think it's important to note about the 40% of corporate profits number. That was at the peak of the bubble. That number is lower today, but it's still not low enough in relation to the fundamental question of how much are we paying for financial intermediation. Right? If the critique that our financial system is causing is destroying retirement security because it's making bad investments is one critique, but there's another much simpler one. It simply costs too much. Right? That the costs of, for example, if you look at the difference in the cost between obtaining your retirement security in the United States through a large public pension fund like the California Public Employee Retirement System, and the cost of doing it through a typical 401k plan invested by a major bank, right? The difference in cost is tenfold. And that just assumes that the investment decisions that are being made are the same, that no one is better than anybody else at making investment decisions. And these types of numbers, which perhaps go back to monopoly power, explain a lot about what is going on. And I would just finally note about monopoly power. The whole point of my presentation has been to focus on size. But it's not strictly an issue of economic monopoly power. It's about the political economy of the size of banks. And it's also about the political economy of the size of the financial system. A group of hedge funds that is benefiting from the unfair taxation regime around capital gains and trading is able to exert political power just as much as a bank is. And so you need to combine limitations on the size and the composition of bank business with limitations on speculative activity generally in the capital markets, which is why an FTT is so important.
Thank you. Okay.
Just two thoughts on monopoly power and finance of investment or finance of capital stock. Monopoly power, I think, is simply difficult to distinguish what exactly is a market and to measure power. I mean, I would go with my previous speaker and say it's size, it's political impact, and it's systemic relevance or systemic relevance, which is important and which I think is the important issue here. Equity finance, we have it. At least for the non-financial corporate sector, which also in Germany is a surplus sector. But it's of course not true for all corporations within this sector, and it's definitely not true for the non-corporate business. And for this, of course, external finance is relevant. And here I would hold that there is no one-size-fits-all. So we have different economies which might different financial sectors or different structures of the financial sector. I mean, take the typical examples, the US innovative model, which might need equity in order to get startups running, and the German standardization high-quality model, which might rather need close relationships with banks. So I think there we would have to take a look at the specific also industrial structure and innovation structure of our economies. And here I think it's important, at least for Germany and maybe for other European countries, to have banks which serve these small and medium-sized enterprises. So in particular public banks or cooperative banks, which, as we know in Germany, mainly serve this kind of business. Okay.
Thank you. I would take a last question. Please.
Yes, and this question would go to Gerry Epstein. You measured your assessment of the size or the oversized financial sector in comparison to a real sector investment. So when you came to the conclusion that the financial sector is too large, I think you can turn it the other way around. Are investments in real economy just too low? And is we have in fact a problem on both sides, on the side of financial economy and what's going wrong there, and also a problem on the real side of the economy and the attitude of entrepreneurs or non-entrepreneurs, but people who are running real economy companies, and in fact what you show is just behaving like a bank and lending to other parts of the economy. And so do we have to combine politics on financial sector with politics on real economy? In a way, perhaps we saw some days ago in Switzerland on this popular vote to have a ceiling on management compensation, also in not only in the financial sector but also in the real economy, just to reshift the focus of the real economy to real investment and not to behave like a bank itself. Thank you.
Okay, thank you. Perhaps very short answers from one or two.
I completely agree with you. The distinction between the real economy and the financial economy is breaking down precisely because of the financialization of certain aspects of the formerly real economy. And Eckhard spoke about that as well. The shareholder value movement and how that has imposed a dynamic on non-financial corporations to make them act more like financial corporations, speculation, cutting jobs, short-termism, and so forth. So there needs to be a restructuring also of certain components of the formerly real economy as well. But I think another place, certainly in the United States, where the size of investment in capital is too low, relates to what Damon was talking about and what Bob Poland was also, in terms of public investment, infrastructure investment. This is too low, too small in many parts of, in many aspects of the United States economy, and that needs to be built up as well.
I think it's very important, just talking about public investment, to recognize that one of the most profound challenges that we face as a global civilization is whether or not we're going to be able to make the investments necessary to address climate change. These are inherently public investments. The nature of the climate problem is fundamentally a problem of the commons. And it requires, it increasingly appears to require the kind of mobilization that typically we seem to only be capable of in the context of the military. When we think about, I think we perhaps have discussed here, that the world economy emerged from the Great Depression largely, ultimately as a result of mobilization for war. And it seems clear, at least to the American labor movement, that were we to actually act with the necessary urgency around climate change on a global basis, and particularly if we did so in the context of understanding that this requires a kind of global New Deal, the New Deal understood not so much as the regulation of activity, but in the sense of raising the level of infrastructure globally to a minimum more of the type of the developed world, that if we did those things, we would get out of the trap that really is the subtext of this entire meeting, which is the trap of thinking, well, we have to choose between if we're trying to think about how to get growth and jobs, we have to choose between the kind of, between export-led growth, which is kind of maybe a mirage looked at globally, another financial bubble, which I think arguably we could say we're kind of doing in relationship at least to equity markets, and when we know where that goes, the perverse logic of austerity, which clearly does not work. If you think about each of these things, and even even I think mainstream economists or the sort of the Hamburg Declaration School folks who say people who basically say, well, where does Keynesian stimulus lead? Right? What's the end game here? Right? In the United States, this goes along the lines of, well, this is just temporary. Right? Making the sorts of investments that would radically raise the carbon productivity of the world's economy is in many respects an escape, a route of escape from this trap. And it's a route of escape that, for reasons of science, we have to make. And the question is not really an economic question, it's a political question. And at the moment, we're failing. I mean, we're profoundly failing, and time is running out.
Thank you very much. I think as lunch is waiting for us, I will leave the sum up to the chairs of the afternoon for the big sum up. So thank you very much for this discussion and for this analysis of the financial system. And well, I think lunch is just beside. Thank you.